Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to have our normal breakdown of kind of that overview, the refined product demand, and then the global backdrop, what's happening over there. And in the last segment, we're going to do a deeper dive on the Chinese teapots. What does that mean for imports? How is that going to shift some things? And we'll kind of pepper that throughout because it's going to shift some of the ways some of these things are moving. Now, I had a request from one of our watchers to give a brief summary at the beginning of kind of like what I'm thinking, how things are shaking out. So I thought it was a good summary, so we'll roll that out today. Just going through the EIA data and what we saw so far. We did get a decent draw for gasoline, which was good in terms of because we've had a pretty steady build. We're right back, right at that 2017, 2016 level. And when you look at what the backdrop is, it's really the distillate side. So distillate is going to continue to build. It normally does on a seasonal level, but just because the spreads have blown out as wide as they have, our exports are going to continue to come under pressure. They started to this week, but that's something that's going to accelerate as we see imports start to increase. So exports are really the big driver right now for some of these draws that we've seen in crude, as we've also seen this run up in refiners. So what we're expecting going forward is exports to come under pressure, refinery throughput to remain at these levels. We'll still have oil draws. They'll just slow just because we're going to have imports to backstop that and the exports slowing. And then we think that we're still going to see some of those gasoline draws along seasonal lines as distillate continues to build. So those are some of the things that we're starting to see. And when we look abroad, we saw some of the international guys trying to take advantage, see, okay, well, the market looks tighter. Let's put this offer, really this bid higher, see if someone comes and chases it. And then we've seen that walk back over the last 2 weeks or so. So those are things where there's this bifurcated market where things are starting to get a little bit better in India, a little bit worse in China, a little bit worse in Southeast Asia. Europe continues to get a bit better, and then we're starting to see some of these flows. But we do have some steady product flow coming into the U.S. As we were saying last week, it was going to pare back off of that million barrels a day. That was kind of that high point, and we think it's going to settle right where it is about right now at 850,000 barrels a day. But again, we'll go through that in a bit more color as we go through the backdrop. But again, this is where we're starting to see where the dollar is going to catch a little bit of a bid. We're coming into Q3 where quantitative easing is not going to be above where Treasury issuance are. So that again, that's going to put some pressure on rates, push the dollar a bit higher, and we think it's just going to cap really where crude pricing is at the moment. And when we start breaking it down as to kind of where things are, given the fact that crude is sitting at 73.70 right now, or I should say WTI, we always look at that day's supply because we wanted to show some of these charts a little bit differently, just so you can see kind of where we're tracking, how we're tracking it. And you can see that typically we have days of supply, they go down in the summer. Why? Because even in 2020, the summer is when we draw. And that's why it's always important to appreciate the seasonality of what we're talking about. We're in driving season, we're in peak oil demand season. So this is really where we should start to see some of these draws, and you can see the rate of change increased and is accelerated. But when we look at 2017, 2016, 2019, there's always that steady move down, which really kind of bottoms out in the first week of September, and then you start to see those builds come back. The rate of change accelerated, and that's where we think that's going to pause. And it's not that it's not going to continue to go down, it's just going to follow a much softer rate of change as we go through, just because the exports will slow, imports will accelerate, and that's going to adjust and slow down some of these draws because the refiners are going to have to run a heavier cut at this point, just given the type of runs that they have, coking capacity, complexity. the oil is going to naturally have to get heavier, which is going to increase that blending side. So that's where we think this is going to continue to move in the seasonal direction, just at a bit of a slower pace. But you can see it's right at that about 30, just below 30 days to cover, which is obviously well below the 34.7, or I should say the 40 plus that we had in 2020. But then when you look, it's right in line with 2017 and 2016, which were very elevated years, if you will, just given where the market share fight started with OPEC. So then when we look at total U.S. commercial oil stock and products, we just want to look at where is the aggregate right now. And again, you can see right here, we're tracking that 2019, just in terms of where we are. You can see that there's typically that acceleration point. And this is where when you start adding in crude and products, you can see that the drawdown is typically a little bit slower. And the reason is because you take oil, and then you crack it into products. So oil draws down, the refiners increase gasoline production, but that inherently also increases distillate production. But distillate doesn't have that demand side for this for really this period. So that distillate is going into storage. You typically get some gasoline draws, gasoline builds, while you have a steady drawdown of oil. So when you put them together, you can see how one just turns into the other, and you have this pretty steady kind of flat line where, typically there's a bit of an acceleration to the downside, but the question is always, what is that rate of change? And here you can see we're pretty close to where 2019 was for this time of year. And, you can see 2017 had that acceleration point, but when we look at 2016, 2019, there's a very gradual movement lower. And that's going to be something that we think we're going to see over the next few weeks, where oil is going to continue to have some of those draws, but you're going to have some of those builds on the distillate side, especially as we start running heavier oil. And that gasoline is going to be kind of that target as we continue to see pretty steady imports at these levels. Then when we look at gasoline, it's always important to see, because 2020 was so elevated, we're right back at those highs that we've been at since 2018, 2017. And we're just on the inside of that. So when you look at really that 5-year average, it's really skewed by that just how massive 2020 was, and just how you had that big drawdown to try to kind of normalize things a bit. But here's where you can see just where we sit right now. We're still at the very top end of the normal range when you take out 2020, still over the 5-year average by a wide margin. Once again, that 2020 is that huge skew. But you can see that we're right kind of within that normalcy, and you can see that typically there's that acceleration to the downside, just because this is the point where you draw. And if you look even at either the top of the cloud or the bottom of the cloud, this is kind of that peak where now you start to see the acceleration to the downside, because you start getting draws, people start driving, and that's where these things that are normally supposed to happen. So it's always a matter of how are they working versus seasonality. And you can see that there was that big spike in storage, and now we're starting to work through some of that buildup. Now, on the distillate side, you can see just based on the trend, this is normally where we start to build. Again, distillate isn't in the same type of demand. The focus is gasoline, so you try to create as much gasoline as possible. That results in just running more heavy, some heavier crudes, as well as some lighter crudes, depending on the process, which puts more disti into storage. Now, jet, you can see, is kind of in no man's land, where 2020 obviously was this massive build, but we still are at, if we take out 2020, all-time highs for jet in storage. And this is one where we'll see some of this drawdown, but it's just going to be the speed of drawdown, which is something that we talk about in the second segment. Now, this is what we've been talking about with weekday mobility, weekend mobility. You can see that weekday mobility on the residential side still remains, as people still have work from home. That's starting to change gradually over the summer. You'll start to see some more people go back. But we're just right back to where we were prior to, within May. So we're just kind of coming back to some of this normalcy. You can see some of that flatlining, but when you look at the weekend side, You saw some of the slowdown on weekend, which is one where we think that you'll start to see a little bit of a reversal. Last week was a fairly strong gasoline demand week, but things started off a bit slower Sunday, Monday, and into Tuesday. And it's now kind of getting to that peak, and then just seeing where you're going to have those movements up and down as fluctuations as we go forward, which is what we've been kind of saying, where we're going to have this move up, and then we're going to go sideways with some moves down, some moves up, but again, staying within a fairly tight range. And then as we go into July 4th, which is typically the peak of driving, then we'll have to look at, okay, well, what comes next as we progress through the remainder of the summer. So when we look at the curve, you can see that the curve still remains elevated, especially when you look at the front end, above 65 well into 2022, above 60 and well into essentially the beginning of 2024, and then the whole curve now is above 55. And now this is all in terms of just allowing for some bigger investments. When you start looking at, okay, well, let's look at offshore. Where can we price this out? Where is the curve telling us it's going to be? And the steep backwardation continues to pull some of this product forward. But one of the things that we had told clients, and now we're going to talk about it again, as things roll and you have hedging, then you have to meet your hedges, but are you going to meet with physical or financial? And when you start looking at the physical side, we've already talked about how we're closer to 11.3, now 11.35 million barrels a day of production. And we'll talk about some of the differences that we're seeing, but this is where some of this crude is being pulled forward to not only meet hedges, but also to try to make up for the fact that some of these hedges were locked in a little bit lower, because they try to do a costless collar where you're long puts and you're short calls, which just means that if the oil price goes through it, so say you're short, let's call it the $60 calls, well, you miss everything above that. Obviously, you sold it for maybe $1, $1.50, so it's really $61.50 that you're going to get. But anything that goes above that, you're not participating in some of that rally. And guys are going to want to try to participate, so you're going to try to overproduce and produce more than your hedges in order to pull some of that forward. So those are some of those incentives that we're going to see and that we have been seeing as we've come into June, and then the acceleration into Q3. So then when we look at COVID in general, just to provide some update, we've had some stabilizing moves in Europe. You can see the UK had a small increase. The US has continued to go down, just at a bit slower pace. That Delta variant, or the Indian variant, is the one that continues to be pretty prevalent. It's prevalent in the sense where it's spreading, but if you're vaccinated, we're seeing that the vaccine is keeping you from getting really sick or sick to the point that you have to be hospitalized, which again is a net positive. So then when we look at India has flatlined a bit, but continues on the right trend. But then when we turn to South Korea, when we turn to Japan, South Korea still remains a bit elevated. Japan has seen a pretty steady down move. But then Vietnam and Malaysia are seeing this kind of stickiness in terms of where they are and where some of those slowdowns sit. And China is now is saying that they're going to keep their restrictions on borders through the second half of 2022. And if you think about it, it's the 100-year anniversary of the founding of the Communist Party. They are hosting the Winter Olympics for 2022, so you want to make sure so there's a lot of these restrictions that are going to remain in place that will cap some of that near-term demand when we're looking at what does the second half of 2021 look like, and in the first half of 2022. Now, when we turn to the U.S., you can see that there was a draw of 7.6 million barrels out of commercial storage. Once we factor in selling down from the SPR, there was a draw of 9.3 million. So when we look at just the backdrop, Cushing drew at 1.83 million, which is something that, as we were saying, it was going just based on spreads, the roll. You had that drawdown. Now you're going to see it flatline a bit, but as we were saying last week, it's going to continue to draw along seasonal lines. It's just going to slow down. This is something that we think is going to be that last little peak, and now it'll still draw. It'll just be at a bit more of a muted pace, where Pad 3 continues to be the biggest drawdown. Pad 2 had another one, but Pad 5, Pad 4, fairly small. Pad 1 had a little bit of a build. But pad 3 is the one that we're going to talk about the most, because that had a draw of 5 million. Pad 2 had a draw of 2 million. And that's where we see some of those imports really increasing, especially pad 3. So that's why when we look at just the pace of draws, that's where we're going to see that slowdown, because we're already starting to see some of that acceleration of those imports, vessels that are flagging the U.S. And then when you look at crude production, this is using a rig model. And just as we've been saying time and time again, there's a difference between where the rigs are and where frac spreads are, where frac spreads ran well ahead of rigs, especially in the first 6 months of the year. That has since started to catch up, and then rigs will accelerate through Q3. So you'll start to see some of that, but that's why we saw some of the rejiggering of, what actual production was, and we continue to see that drift higher. That's going to, again, put more into Cushing, put more into pad 3, and that will help mitigate some of those draws. Not to say that we won't still get draws, but it's just a matter of what will the pace be. When we look against the 5-year average, 7.6, where it's 37 million below. But again, that 2020, which is why in the first part of the segment, we look at it against multiple years, or 29 years really, to look at where are we normally, what do we normally see. And even though we're technically 37 million below the 5-year average, we're still very elevated on days of supply, just given where 2020 was and just what the refining capacity is in the U.S. But these are things to watch, and we'll continue to talk through as we continue. Now, when we look at land storage, we had some nice draws coming out of the U.S. and the ARA. Now that has started to adjust. The ARA in Europe actually had a build of about 3.7 million. Where the U.S. had a draw of 7, so we'll still get a net draw, which is a net positive when you look at stockpiles. Last week stockpiles fell 17 million to 634.5 million barrels. You can just see kind of where we're finally starting to get towards that end. It's just going to be a matter of what happens on the east of Suez, because we were tracking 2020, had a nice little reversal, but now the Shandong teapots are really getting hit with their import quotas are cut by 35%. And then, so that's going to continue to draw down. They're going to draw down their own inventories. But what does that mean in terms of the shift of flow? Because now they're not going to import 35%. Who's going to import it? How much will the SOEs pick up? How much of it's going to be left in the water? And how is that going to adjust and kind of find its way into the market? Which is why we continue to see more and more of this crude getting pushed into the Gulf of Mexico as our spreads continue to essentially weigh on where our crude exports and what our imports look like. So then when you look at floating storage, you can see that we're still tracking, obviously well below 2020, but still elevated when you consider where we are previously and where we have been. And it continues to reside within the east of Suez, where even though we've seen land storage come down, we're still elevated in terms of storage. There's a lot of delays that continue to remain. We'll talk about that in the Econ show, but those are pressures that we're continuing to see within the region. And again, that's going to leave some of this in the water. But we are starting to see a little bit of an increase in crude in transit, which is something that we're going to talk about in segment 3, because some of this has gone from floating to transit, and then once it gets to its location, it turns back into storage, depending on timing. But we're going to see some of that again go back into the timing side. Now, one of the things that we had said was that China was closer to about 90%. And here you can see just where we were, because this has started to get picked up again on the TomTom side, where you can see China got to about down to as low as 80%. And now it's kind of holding in at this 90. And it's all because when you look at Guangdong, they've had multiple outbreaks now. They have really locked down where some of their people can go. They have a lot of restrictions, and it's one of the richest provinces. So to have one of the richest provinces having one of the broadest lockdowns right now, it's going to hinder activity. We're already starting to see that. And then when you look at rest of Asia has slowed down as well. Even though India is starting to come back, other parts of Asia either remain very low or continue to slow, which is weighing in on where things sit. Europe, again, is kind of finding this comfort range where we've kind of gone sideways based on that. And then North America, or really the Americas, has been fairly flat, just given the headwinds that remain within Latin America. Now, just to give some kind of guidance on the current state of play at the Chinese border, new visas are basically only issued to foreigners who have had a Chinese vaccine. New arrivals must quarantine for at least 14 days. There are a few potential political explanations. It's obviously the Beijing Winter Olympics. 2021 is the 100th anniversary of the founding of the Chinese Communist Party and the 20th National Party Congress, where there will be a transition of power from Xi to Xi will take place in October 2022. So there's a lot of reasons why you'll see some of these adjustments in general. And this is just looking at some of those, a bit deeper dive into some of those breakdowns, because you can see India's has seen a lot of recovery on the gasoline side as we go into June, but then when you look at Thailand, when you look at Indonesia, South Korea, Japan, you're seeing a lot of these slowdowns and some of these headwinds in general, which again is keeping things a bit slower when you consider kind of where some of these demand levels are when we look at especially Malaysia, Vietnam, Taiwan, as you've seen some of that slowdown, again, weighing on some of the near-term levels. Then when we look at crude in storage, this is, again, looking at things on just the spread level on as of 2020. 2020 is obviously at these highs, but when we look at 2019, when we look at 2017, you can see that there's typically this drawdown that goes until about, let's call it like the first week of September, last week of August. And then you start to get those builds. And then the question is going to be, what is the pace of draw? Because right now we had some nice acceleration, and now we're starting to pace with where we should be right now. And the pace is going to slow just based on the import-export shift, which we've been talking about, and we're starting to see now come to fruition this week. But really next week and into July, we're going to start to see that accelerate, as we're going to start pulling down more imports. Now, when we look at pad 3, here's where you can see kind of where things sit. And that's why when you talk about the 5-year average, you can see just how sizable 2020 was in comparison to the, really that normal kind of bucket, really. And we're just back to the 2016, 2017 levels, which, if you remember, that was the OPEC market share grab. There was a lot of crude that was pushed into the market. There was a lot of excess. So here, we've started to go through that, and we're starting to track really where we were on 2019 when you look at what those draws look like. Because if you look at those, essentially the line here, the rate of change is very similar. This is where on pad 3 specifically, that's going to kind of flatline, and we think it's going to track something closer, which were still draws, but something closer to what 2017 and 2016 looked like, as we start to become kind of the dumping ground, or this in the level, because we do have some of the best demand in the world versus where some of the rest of the world is, which is going to attract just more coming into the U.S. Now, when we look at Cushing, here's where you can see that we had a nice little acceleration. This orange line, or pinkish line, really is that 15-year average. So when we go back to 2006, you can see that we're just coming right back into this comfort level, really, in terms of where things are. But when you just look at the general trend, the trends always see this acceleration. You typically have this pivot point, and you see an acceleration to the of draws as we go into the end of August. So it's really not something surprising. It's just we were starting at a lower level, and now here that's why we with some draws, and then we're going to flatline. It's still going to move along the seasonal line. It's just the pace of those is going to adjust and moderate. So when we look at imports increased 197,000 barrels a day, which is something that, again, we were saying last week. It's still 660,000 below the 5-year average, and that's where we're going to continue to track closer to the 5-year when we look on the import side. And it's going to be driven by pad 2, pad 3, and pad 5. And you can see just where pad 2 continues to remain strong. 111,000 barrels a day was the increase week over week, 227,000 over the 5-year average. But pad 3 is still 700,000 barrels a day below the average, even though that we did get an increase of 162,000 barrels a day week on week. There's still room to close, and we continue to see that close overall, which is why we're going to see some of these shifts. Now, just bringing this back to where China is, these changing dynamics when we look at trade routes. Higher gas oil exports from South Korea are putting downward pressure on the 500 ppm sulfur grade, which is high sulfur diesel. According to the FGE, shipments have increased after refiners lost a major outlet for high sulfur gas oil barrels into China, given the consumption tax on imported light cycle oil. Asia's gas oil complex has been firm in recent weeks, supported by improving demand in Europe and India and less exports from China. So that's where the improving demand in Europe is what we've been talking about, where we continue to see an export from Asia into Europe. And that has now resulted in a build in some of the European refined products, and we'll talk about that more in segment 3. But overall, gas oil surplus in the Asia region is likely to widen sharply as refineries refiner runs climb, and that's where we continue to see some of these headwinds, because refiners continue to work their way up. They continue to crack more crude, but we're seeing some fairly big headwinds mounting when we're looking at just where crack spreads are, and crack spreads continue to come down and struggle. So then when we look at U.S. runs pared back about 0.4%. So still right within kind of that normal seasonal range of 92.2%. We did have a hiccup in pad 3 where a refiner tripped. So we did get some of that reduction, which if you look at just where things are, that was essentially the full reduction. So that is now back on. That will bring things back to normal. So we'll, just based on where we see things going, we'll be back to either 92.6 or 92.8. Moving much closer to kind of that 93%, which when we look back over time is right within kind of that normal run rate. Then when we look at implied demand, I think this is where it gets a bit even more important, because gasoline was sticky with a small increase of 80,000 barrels, back to 9.44 million barrels a day. That's one where we thought we were going to get a little bit of a drop back. Instead, we had a little bit of an increase. Now, again, it's just going to be this normalizing level along these lines. Now, Disti had the pullback that we were talking about of a decline of 389,000 barrels a day. Jet had an increase of 326,000 barrels a day. So this is where you're going to start to see some of these flip, where gasoline will come down a bit, Disti will come up a bit, jet fuel will come down a bit. And that's why we're always talking about that 4-week average, because that's where you can kind of get through some of the noise, because they're lumpy deliveries. And when you see that lumpy delivery, that's where you see some of these fluctuation points. Now, propane had an increase of 309,000 barrels a day. That's going to remain elevated. And again, propane is the one where we continue to see that elevated level. Distillate is the one that also remains elevated, and we'll continue to see that drive through. So gasoline and jet fuel, even though we have seen an increase in demand, we still are at record levels. Obviously, 2020 was its own case, but either at or near record levels in storage. So there's a lot to work through, even though jet is going to face some additional headwinds into July, as we have seen some renewed cancellations for some of these flights. And we'll talk about that a bit more in segment 3. Now, stockpiles of light distillate and the distribution in Singapore, when we look at the levels, in Singapore, we continue to see these builds. So this was partly due to, again, we had a reduced exports from the city from Southwest Asia. Malaysia, it continues to be kind of this struggle point, where when we look at kind of what's happening, we continue to see these builds in refined products. We saw it in Singapore, we saw it in Fujairah, and now we're going to continue to see some of this come into the U.S. as it tries to find a home. And we are the best place in the world right now to sell a lot of this product, which is why we're going to continue to see it drop into our world. But while all of this is happening, we continue to have supply disruptions within the U.S. They're still small, not enough to really move the needle, but they're starting to become more and more frequent, where the cash market gasoline in lower Midwest rose to a 7-week high as there were regional shortages with, and that's where we continue to see some of these regional shortages, which is going to lead to some lumpiness Again, not a huge amount to really drive the number, a million in one direction, but there's still enough that there's going to be some noise in there, which is why we could see a nice number to the upside, a little bit of a disappointing number to the downside, which is where we always want to look at what is that average coming through. So then the U.S., in terms of imports in general, the U.S. received European gasoline on all three coasts, lifting total imports to a 3-week high through June 17th, which again is something that we're going to continue to see over this time period. We were at about 419,000 barrels a day, which is the most since May 27th, which compared with 316,000 barrels a day in the previous week, which is why, again, we're going to see some of the stickiness in terms of where things sit on our import level, which we'll talk about more in segment 2. And then 8 tankers discharged about 2.3 million barrels of gasoline at the U.S. East Coast. And when we look at kind of what comes next, we had 8 on the East Coast, 1 at the Los Angeles on the West Coast, and 1 on the Gulf Coast. We will have more coming into Pad 5, which is the one that we're going to talk about, especially as, again, China has the cut in terms of where private oil refiners, are going to have that pressure on those import quotas. So then when we look at floating storage remains fairly flat when you look at week over week coming into the U.S. This is one where we continue to see this moving closer and coming into the lower end of the cloud as we attract more imports, and there's that timing delay between when things come in, when things get unloaded. And this is where when we start talking about import data, even though week over week the floating storage was flat, we still had a big increase in imports. As we said last week, we expected to come back into the bottom of the cloud. Now, there's going to be some of this timing delay as to when does it show up. This is one where we think it's going to continue to rise, but at a slower pace versus the last 2 weeks. But this is where we're going to continue to see some of this acceleration. We're still obviously well off of that 5-year level, but still moving towards as we get some of these Pad 3 refiners getting a bit more active. And as we were saying in Pad 2, a bounce off the lows, we continue to believe that we're just going to hang within this, above the 5-year, but below the top of the range as we, struggle, not struggle, but as we take down more Canadian, and as they try to source as much crude as possible to essentially meet a strong cash margin, especially with some of the shortages just due to shortage of drivers, some of these logistical issues that we've talked about previously. Now, when we look at the 29-year average on crude on refinery utilization rate, you can see that we're just perfectly in line with what's normal. If we go over the last 5 years, we're typically a little bit higher. But again, this is just based on where we sit right now. This is a fairly normal number, and we just think that we're going to continue to track along that average, which just means that we're going to continue to move closer to about 94% as we get into peak driving season, which is typically within that first few weeks of July. Now in the next segment, we're going to look at, a bit deeper into refined products, U.S. refined products, and really where that demand is going to go to next.